Your retirement money could soon be parked in Bitcoin, a slice of SpaceX, or a secretive hedge fund, whether you asked for it or not. That single sentence is already dividing dinner tables and LinkedIn threads across America, and it's only the beginning. On the surface, the freshly signed White House directive sounds like a gift. Open the 401k gates to crypto, private equity, venture capital, and other alternative assets so everyday workers can chase the eye-popping returns once reserved for billion-dollar endowments. But peel back the marketing gloss, and you'll find a minefield of hidden fees, murky disclosures, and liquidity traps that could turn your golden years into a guessing game. But here's where it gets controversial. The cheerleaders, led by Trump-era policymakers and a growing chorus of fintech founders, argue that letting Jane from accounting own a sliver of OpenAI or a crypto index is the ultimate democratization of wealth. Their pitch: if Yale's endowment can compound at 12% a year thanks to private assets, why not your $75,000 nest egg? Skeptics fire back with a simple reality check. These investments have never been stress-tested inside a 401k during a 2008-style meltdown. Christopher Bailey at Cerulli Associates puts it bluntly: none of it has been through a real storm yet. Translation: when markets seize up, you can't sell a stake in a pre-IPO rocket company as easily as you dump a Vanguard index fund. And this is the part most people miss: the fee story. Traditional mutual funds inside 401ks charge an average of 0.26% a year. Private equity, the classic 2 and 20 formula. 2% of your balance annually plus 20% of any profits can quietly siphon off 6 figures over a career. Philitza Hansen of All View Systems warns that many of these costs are buried in footnotes or layered across multiple fund vehicles. Plan sponsors will need a decoder ring just to explain where the money goes, she says. Let's zoom out. For the last 30 years, the retirement industry has marched toward lower costs, daily liquidity, and crystal-clear statements. This executive order risks slamming that trend into reverse. Dimitri Katznelson at WealthSpire Advisors notes that if millions of workers suddenly gain access to exotic assets, we're asking record-keeping systems built for T+1 settlement to price something that might trade once a quarter, if at all. Imagine checking your 401k app and seeing a placeholder value for your SpaceX allocation because pricing is pending the next funding round. That's not a glitch. It's the new normal under this framework. So who should actually dive in? Blackstone COO John Gray suggests younger investors with decades until retirement might stomach the volatility and lockups. Someone 2 years from punching the clock? Probably not. Yet the order doesn't draw those guardrails. It leaves the door wide open for a 64-year-old to unknowingly park 30% of their balance in a crypto venture fund. And the legal headaches are already brewing. Intel employees spent 7 years in court arguing that hedge fund and private equity options inside their 401k were too risky and too opaque. The case was ultimately dismissed, but not before racking up millions in legal fees, costs that smaller employers simply can't absorb. Unless regulators offer a liability shield, plan sponsors may decide the headache isn't worth the hype. So what's an ordinary saver to do? 1. Demand transparency. Ask your HR team to spell out every layer of fees in plain English. If they can't, that's a red flag. 2. Start small. Treat alternative assets like hot sauce. A dash can add flavor. A bowlful can ruin the meal. 3. Rebalance more often. Illiquid assets can skew your risk profile without you realizing it. Now for the spicy question. Is this executive order a visionary leap toward wealth equality, or a backdoor invitation for Wall Street to slap high-fee products onto Main Street portfolios? Sound off below. Are you excited to diversify into crypto and SpaceX within your 401k? Or do you think the government just opened Pandora's box? Let the debate begin.